Two of the most heavily marketed active trading approaches on the internet are Forex and penny stocks. Both attract enormous audiences, but both also attract an enormous amount of low-quality content, and in the case of penny stocks, some outright fraud. This episode gives you a clearer picture of what each approach actually involves, what the risks are, and how to evaluate whether either one is a realistic candidate for your income engine. We'll also close the income engine section with a look at the full comparison across all 5 approach categories, and give you the framework for arriving at your own working hypothesis before we move to the growth engine episode in episode 21. Forex, which is short for foreign exchange, is the global market for trading currencies. When you trade Forex, you're buying one currency and simultaneously selling another, aiming to profit from the change in the exchange rate between them. If you buy the euro against the US dollar, and the euro strengthens relative to the dollar, you profit. If it weakens, you lose. The market operates around the clock, 5 days a week, across major financial centers in Asia, Europe, and North America. That near 24-hour availability is one of the things that attracts many investors to Forex. You can find a trading window that fits almost any schedule. The liquidity in Forex markets is also enormous. The daily trading volume in global currency markets dwarfs equity and futures markets by a very large margin. This means you can enter and exit positions quickly and at predictable prices, which matters for active trading approaches where execution quality affects outcomes. The accessibility of Forex is also genuine. You can open an account with a relatively modest starting amount through many brokers, and the range of currency pairs available gives you a broad set of instruments to work with. The leverage available in Forex deserves its own discussion as well, because it is significantly higher than what is typically available in futures or equity markets. Many Forex brokers offer leverage ratios that allow you to control positions many times larger than your account balance. This amplifies both gains and losses in ways that can be dramatic. A small adverse move in an over-leveraged Forex position can wipe out a significant portion of an account very quickly. Now, this is not a reason to avoid Forex necessarily. Leverage is a tool, and tools can be used well or used poorly. But it does mean that risk management discipline, and specifically the rules governing how much of your account you risk on any single trade, is even more critical in Forex than in other active trading environments. Any Forex mentor worth following will treat risk management with the same seriousness as the trading method itself. In practice, look for a mentor who specifies a maximum percentage of account capital at risk per trade, and demonstrates their own adherence to that rule in their live trading content, and discusses losing periods with the same level of transparency as winning periods. The mentor landscape in Forex is where the most significant caution is warranted. Forex has historically attracted a higher proportion of low-quality content, fraudulent schemes, and misleading promotional material than other trading categories. Now, this does not mean that good Forex mentors don't exist. They certainly do, and some of them are genuinely excellent practitioners who teach replicable, risk-managed methods with transparency about the results. But the ratio of genuine expertise to performance and promotion may be lower in Forex than in most other spaces, which means that the credibility tests from episode 12 need to be applied with particular rigor here. What you are specifically looking for in a Forex mentor is verifiable live track record over a meaningful time period. Not screenshots of winning trades, but a documented history of results that includes losing periods as well as winning ones. You want a method that is specific enough to paper trade during the 30-day evaluation process with defined entry criteria, exit criteria, and risk management rules. And you want a mentor who addresses the leverage reality of Forex specifically, not just general trading risk management principles, because the leverage environment in Forex creates specific risks that require specific discipline. Now, who does Forex trading suit as an income engine approach? Well, it's a genuinely strong fit for investors who want 24-hour market access and who appreciate the flexibility that provides. It suits people who already have some familiarity with currency markets and want to systematize an approach that they've been developing informally. It suits investors who can apply rigorous risk management discipline in a leveraged environment, which is not everyone, by the way. And that's worth assessing candidly about yourself before committing to Forex as your path. It's generally less suited to brand new traders who have not yet developed any sense of risk management discipline in a live market environment, because the leverage available in Forex markets can produce very large losses very quickly when discipline breaks down. On the time commitment side, Forex offers genuine flexibility that other markets do not. Because the market operates around the clock across different sessions, Asian, European, and North American, you have a real choice about when you trade. Different currency pairs have different activity levels during different sessions, and the method your mentor teaches will typically be calibrated to specific session windows where its approach works the best. This is a practical advantage for investors whose schedules do not align well with equity market hours in their region. Penny stocks are shares in companies whose stock price is very low, typically defined as below $5 per share, though some definitions use different thresholds. The companies themselves are often small, early stage, or financially distressed, and in many cases, they trade on markets with less regulatory oversight than major exchanges. The appeal of penny stocks is easy to understand. When a stock is trading at 50 cents a share, a 10-cent moves represent a 20% gain. These dramatic percentage moves and the low per share price that makes large share quantities seem accessible creates a compelling surface level impression of opportunity. This impression is reinforced by the large amounts of promotional content that exists in the penny stock space, content showing accounts multiplying dramatically through a series of apparently easy wins. The reality of the risk profile is quite different. Penny stocks are typically thinly traded, meaning there are relatively few buyers and sellers at any given time. This thin liquidity makes it difficult to exit a position quickly without affecting the price. When you want to sell, you may find that there are not enough buyers at the price you want, and the act of selling itself pushes the price lower. In addition, penny stocks are particularly susceptible to manipulation. A promoter who accumulates shares in a thinly traded stock and then promotes it heavily can cause the price to spike, attracting buyers who then become the exit liquidity for the promoter's own shares. This is called a pump and dump scheme, and it's more common in penny stock markets than most promotional content acknowledges. The mentor landscape for penny stocks carries the same caution as Forex, but amplified. Penny stock content has historically been one of the primary vehicles for pump and dump promotion, where someone builds an audience through trading content and then directs the audience towards specific stocks that they hold, profiting from the resulting price increase. Now, this does not mean that every penny stock educator is engaged in promotion. Some teach genuinely replicable methods in lower capitalization stocks without directing students towards specific positions. But distinguishing between the two requires careful evaluation. The most important thing to look for, and the clearest red flag in this space, is whether the mentor promotes specific stocks in their content. A mentor who teaches a method for identifying and trading lower capitalization stocks without pushing specific names is teaching trading skills. A mentor who regularly highlights specific stocks as opportunities for their audience, particularly stocks they have positions in, is potentially doing something different and more problematic. This is the single most important filter to apply before engaging with any penny stock mentor. Now, beyond that red flag, the same credibility tests from episode 12 apply with full force. Verifiable live results over a multi-year period, including losing periods. A method specific enough to apply independently, explicit and consistent risk management and guidance, and a teaching approach that produces replicable results in students rather than ongoing dependency on the mentor's stock picks. Now, who might penny stock trading suit as an income engine approach? Well, it's genuinely not a category that we would recommend for someone building their income engine from scratch. The combination of thin liquidity, manipulation risk, and the mentor landscape quality issues make it a difficult space to navigate without significant prior market experience. The investors best positioned to run a penny stock approach are those who already have real experience in lower capitalization stock markets and have developed a specific and tested edge in that environment, and are looking to systemize and improve what they already do. For someone starting the income engine from the beginning, the other approaches we've covered in this module provide a more reliable foundation. If penny stocks are genuinely on your shortlist, despite that caution, apply the 30-day trial process for Module 2 with particularly close attention to two things. The first is whether the mentor promotes specific stocks during your trial period. Any stock promotion directed at the audience during the trial period is a clear signal to move on, regardless of how compelling the rest of the content is. The second is whether the method produces results that you can replicate in your own paper trading without needing the mentor to tell you which stocks to look at. A genuinely teachable penny stock method is one where you can apply the selection and trading criteria independently. If the method requires the mentor's specific stock picks to function, What you have is a stock picking service rather than a transferable skill. The 5 categories that we've covered across episodes 18, 19, and 20, futures, active stocks, options income, Forex, and penny stocks, represent the most common income engine approaches. Now, they are not exhaustive. There are other active trading approaches out there, and new ones continue to emerge. Commodity trading, for example, taking directional positions in oil, gold, agricultural products, or other physical goods through futures contracts, that's a category that some active traders pursue. The 5 we've covered are a representative sample of the landscape and capture the most widely followed approaches. But the principles for evaluating any of them are the same, regardless of how familiar or unfamiliar the specific instrument is. Now, regardless of which approach you encounter, whether it's one of the 5 we've covered or something different, the criteria for evaluating it as an income engine candidate are the same. Does the approach generate consistent monthly cash flow through active market participation? Can the method be described specifically enough to be replicated by someone learning it? Is risk management built in as a core component of the method rather than as an afterthought? And can you find a mentor who demonstrates live results in the approach with transparency about both the wins and the losing periods? If an approach that interests you passes those 4 criteria, it's worth evaluating further, regardless of whether we've discussed it here. The 5 categories in this module were chosen because they are the most widely used and the most likely to appear in your research. But the income engine is ultimately defined by what it produces, regular monthly cash flow, not by which instrument you use to produce it. The instrument is the vehicle. The criteria are what matter. There's also a practical consideration about market access and regulation that applies to any approach that you're researching. Trading regulations, platform availability, and tax treatment differ by country and jurisdiction. An approach that's straightforward to access in one country may face regulatory restrictions in another. Before you commit time to evaluating a specific approach, verify that you can actually trade it in your jurisdiction through platforms that you can access. This is a simple check that can save significant time. As the content landscape for active trading continues to evolve, new approaches will emerge that we've not discussed here. Cryptocurrency trading, for example, has developed into a substantial active trading category of its own, with its own instruments, its own market dynamics, and its own mentor landscape. When you encounter something new and unfamiliar, the 4 criteria above are your filter. They're not specific to any instrument or market. They describe what any approach needs to demonstrate before it's worth your serious evaluation. So we've now covered all 5 primary income engine approach categories. Before you move to the growth engine episodes, this is the moment to step back and form your working hypothesis about which direction feels most right for your income engine. Looking at the 5 approaches together, futures trading offers the highest capital efficiency from a small starting account and the cleanest scalability, but requires real-time presence during trading sessions and carries meaningful emotional demands. Active stock trading is generally more accessible in terms of starting capital and spans a range of intraday styles with daily presence requirements to swing-oriented approaches that can be managed with much less frequent engagement. Options income trading varies significantly by style, has a longer learning runway than the other approaches, but can be a strong fit for investors with genuine interest in options mechanics. Forex offers 24-hour market access with strong liquidity, but carries a mentor landscape that requires particularly rigorous evaluation. Penny stocks carry the most risk and the most problematic content landscape of the 5, and are generally better suited to experienced traders than to those building an income engine from scratch. Your working hypothesis does not need to be certain. It needs to be specific enough to drive the mentor search and the 30-day trial. It also does not need to account for every variable. The trial process will surface information that you cannot know from description alone. A statement like, "I think swing trading individual stocks suits my schedule and starting capital better than futures, and I want to find a mentor who teaches a rules-based swing trading method," is a perfectly good working hypothesis. It's specific enough to tell you what to search for, what to evaluate, and what the 30-day trial should test. If you're genuinely torn between 2 approaches, that's also fine. You can begin the evaluation process for both simultaneously. 1 approach per engine means 2 concurrent trials is manageable, since they involve different activities and different mentor content streams. The trial process will usually resolve the uncertainty through direct experience. Deciding which approach fits better from a description is harder than deciding after you've experienced both in practice, even briefly. Write down your working hypothesis before the next episode. Include the approach that you're leaning toward, and the key reasons you're leaning that way, and any significant reservations that you still have. The reservations are useful. They tell you what to pay particular attention to during the evaluation process. An investor who knows that they're uncertain about whether they can sustain the time commitment of their chosen approach should structure their 30-day trial specifically to test that question. One more thing that's worth saying before we move to the growth engine. The income engine working hypothesis that you form now will almost certainly look different in 12 months. You will have tried a method, perhaps switched to a different one, developed real execution experience, and gained clarity about your own temperament and schedule in ways that are impossible to know in advance. The hypothesis is the starting point. It gets you into the process. The process is what teaches you what the right approach actually is for you. Treat the working hypothesis as your best current thinking and stay open to revising it as the trial process produces real evidence. If you have gone through all 5 Income Engine episodes and still do not have a strong sense of direction, consider starting with the approach that presents the lowest barriers for your current situation, whether that's starting capital, time flexibility, or learning curve. The best working hypothesis is the one that gets you into the mentor evaluation process where real experience will clarify the right fit faster than any further description can. Episode 21 moves to the growth engine. We will cover the wheel strategy, what it involves, how it actually operates in practice, and who it suits well. The growth engine episodes are structured the same way as the income engine ones. What the approach is, what it feels like to run it, and a clear-eyed look at who it suits and who it does not. Come in with your income engine working hypothesis noted down and approach the growth engine episodes with the same evaluative mindset. Remember to like and subscribe so you do not miss episode 21, and we'll see you there.